Namaskar. In session number 36, we will be discussing about money and forex market interaction. As I mentioned earlier, money and forex markets are highly related to each other. Money market is highly liquid. It takes into account the call money market, certificate deposit market, the commercial paper market, government treasury bill market, and forex market also, as we discussed earlier session, highly liquid market. Both the market, since they are highly liquid, they interact each other and transfer the what is called spillovers. Spillovers means in the area of information spillover from one market to another market. The volatility which created in one market, that is in money market, get transferred to the forex market and vice versa. So, the interaction process we should understand, because this interaction process gives rise to volatility in the spot market and also volatility in the money market. It may happen that the volatility transfer from one market to another market can be checked if you understand the nature of the volatility, the nature why volatility is occurring, because of the shortage of money in call market, or maybe highly volatile forex market, for which the call money market or the near term money market are highly volatile. So, to understand the interactive process of money and forex market, let us do a exercise how these two markets are related to each other. In this area, we will be discussing about the covered interest parity, uncovered interest parity, and also we will discuss how the forex market, the FI investment and the stock market related to each other, whether the volatility in the stock market because of fluctuation of FI investment may lead to any instability money market. We will also discuss about the same thing. Let us start what actually the composition of money market. As I mentioned earlier session, if you see the money market, it is a market having maturity overnight to 15 days, maybe less than 1 year, also less than 1 year in some other segments of money market. However, in case of call money market is less than 14 days market. So, the money market having a maturity overnight, that is call money market overnight, to a less than 1 year market, that is treasury bill, commercial paper, certificate deposit, these are the less than one year market. So, in the money market we have call money market. This call money market is a purely interbank market, because it was earlier non-bank financial intermediary, that is the insurance sector, investment banking sector, they were the part of the call money market, which is not now at present. Call money market purely interbank market, only commercial bank participate in the call money market. The volatility of the call money market indicates the barometer of financial sector. So, because why? Because call money markets is the highly liquid market, reflect the market liquidity in economy. So, the volatility, the high interest rate call money market indicate instability in the near money market or instability in the money supply process. So, call money market is a highly liquid market, it is the highly active market in money market. Similarly, we have certificate deposit market. Certificate deposit market generally 7 days maturity to 1 year maturity. Generally financial sector, financial institution, they raise money through certificate deposit, and other financial institution, maybe trust, maybe municipality corporation, they participate as a investor in certificate deposit market. Similarly, institutional also, big financial institution, big government companies, private sector company, they also participate in certificate deposit market, they invest in certificate deposit market. Similarly, we have commercial paper market. Commercial paper, also you know that it is a working capital requirement of financial your working capital requirement of manufacturing side company, non financial company. So, the non-financial company to meet their working capital requirement, they raise money through commercial paper, trust, financial institution, they participate as a investor in commercial paper. Commercial paper, though it is a highly rated instrument, without rating commercial paper cannot be raised, cannot be issued in Indian financial system. The another segments of money market, it is the treasury bill. Treasury bill generally act as a working capital requirement of government institution, government bodies, central government, private your central government, and also municipality corporation. Maybe treasury bill also issued by financial institution, that is your government body, government corporation. So, treasury bill, then generally banks and financial institution, they invest in treasury bill, and it is the government bodies, government institution, they raise treasury bill. In the treasury bill market also, there is a secondary market for treasury bill, and it is a liquid market also. So, if you see the money market instruments are commercial call money market, overnight to 14 days market. We have a certificate deposit market, it is a 7 days to 1 year market, commercial paper market generally 1 year market, and treasury bill 14 days to 364 days treasury bills are available. It is also 14 days market to 1 year market. However, in call money market we have a secondary market, certificate deposit market there is no secondary market, commercial paper market also rarely having secondary market, only treasury bill have a secondary market. So, if you invest, the government body financial institution invest in treasury bill, or these bills are traded in financial in as a secondary market in RBI windows of negotiated dealing system. So, only in treasury market in India we have a secondary market activity. If you see the money market, the active segments of Indian exchange market, if you see the foreign exchange market, though it is highly active, it is highly liquid market, but there are some segments of forex market they are not liquid. The highly liquid in foreign exchange market segments are foreign exchange spot market and some extent foreign exchange forward market. Nowadays, foreign currency options market also little bit liquid. However, foreign currency spot market is highly liquid market. Then question arises here, which are the factors affecting foreign exchange market in India. So, if you see as I mentioned earlier that money market and forex market are interactive to each other. However, the money market rate, the FI inflow, the FI outflow, the current account deficit and surplus the government of India, the export imports, then industrial production, GDP growth, inflation, equity market return, these are the factors which actually influence the foreign exchange market. However, among these the FI inflow outflow, the equity market return and the current account deficit and surplus generally influence the forex market significantly. So, we have to understand the nature of the alignment of this factor along with the foreign exchange market fluctuation. So, when you discuss about the money market and forex market interaction process, we should understand that the both markets are buyers and sellers are same, almost same if you see, since in the buyers and seller in money market also having the exposure in forex market and vice versa. So, since the buyers and seller, the participant in both market are same, they take position in each other market to take the arbitrage opportunity. So, why the arbitrage opportunity occurs? It is because of the parity condition. So, money and foreign exchange market are interactive through the parity condition. So, one determinant of forward premium and discount, it is influence on exchange rate. Three important hypotheses has been developed, because the forward premium, the forward discount of a particular exchange rate between INR or along with USD, why the USD is a premium currency against INR, why the INR is a discount currency against USD, it depends on that basis we have a 3 different kind of hypothesis. So, as we know, we were discussed earlier, we have interest rate parity hypothesis. The hypothesis mentioned, first hypothesis here, the covered interest hypothesis, because the interest rate differential, it is interest rate differential between India and US is related to the forward rate or the forward premium. The forward premium is a function of interest rate differential. In other words, the interest rate differential, the amount should reflect in the forward premium itself. The forward premium should bridge the gap of interest rate differential. If the currency, if the currency is a premium currency, forward premium should reduce. If the currency is a discount currency, the forward premium should increase. So, if the forward premium reflects the interest rate differential, then there cannot be any arbitrage opportunity. The question arises here, the interest rate differential come from the money market segments of India and money market segments of US. Since you are discussing about India and US, the currency exchange rate. So, if there is a money market differential interest rate between India and US, then forward premium to bridge the gap. By bridging the gap, you understand that there cannot be arbitrage opportunity between Indian INR and USD, or there cannot be arbitrage opportunity if you travel through money market to forex market. So, along with the macroeconomic factor, the parity condition decide the movement of exchange rate. If the interest rate differential is there, then between Indian rupee, interest rate differential between Indian interest rate and money market of US interest rate, then Indian rupee will depreciate against USD. Similarly, if the interest rate differential is negative, that is Indian interest rate is less than US interest rate, Indian currency will appreciate. So, along with the macroeconomic factor like the inflation, IIP, the current account deficit, the growth parameter, the interest rate differential or the parity condition also decide the movement of exchange rate. Any deviation from the parity create arbitrage opportunity and it will be reflected in the premium or discount in exchange rate. So, this parity hypothesis are covered interest parity as I discussed with you, uncovered interest parity and real interest parity. Covered interest parity mentions us that interest rate differential should equal to the forward premium. Uncovered interest parity mentions us interest rate differential should reflect in the change in the spot rate, and real interest difference parity mentions us that the inflation adjusted covered interest parity. So, the real interest differential should reflect in forward premium or discount. When you discuss about this money market and forex market interaction, we should also discuss about the international features effect. As I mentioned earlier, the international features effect explained that change in the current exchange rate between any two currency is directly proportional to the difference between these two countries nominal interest rate at a particular time period. The Fisher effect explains that change in the exchange rate between two currency is a function of nominal interest rate differential between two currency, two country. Similarly, it means that percentage change in the spot exchange rate over a period is the difference between nominal interest rate for the two currency. So, whenever there is a real interest rate difference is there between two currency or the nominal interest rate difference between their two currency, it will be reflect in the exchange rate change. Interest rate parity or the interest rate differential between two countries get adjusted in forward rate between the currency of the two countries. If the interest rate differential reflect in forward discount or the forward premium and it will be equal, then there will be no arbitrage between money market and forex market. Similarly, interest rate differential reflect either in forward points or get adjusted in exchange rate itself in the form of appreciation or depreciation of currency. If the interest rate differential reflect in forward premium, there cannot be arbitrage between two countries. Similarly, if interest rate differential reflect in either change in the spot rate, then there will be no difference in no arbitrage between forward market between money market and forex market. So, we have to discuss these two different hypotheses, that is the covered interest parity, uncovered interest parity in detail, so as to understand the money market and forex market interaction process. So, when I mentioned that call money market and forward call money market and forward premium should move to in a tandem to each other, because whenever there is a call money increase, the forward interest rate should also forward premium or discount forward premium should also increase. So, that cannot be arbitrage between money market and forex market. If you see Indian context, I have drawn a graph over the period 93 to 2012. Then what is the movement of your call money rate? Call money rate is a red line, if you see, and the movement of call money rate is a red line over the period. The call money rate over the period declining and remaining at around 5%, and the green line indicate the forward premium. So, forward premium all up to 2000 up to 99 2000 it was not moving in tandem. After that it significantly with the movement in tandem with the call money rate. However, since there is some kind of differential exists between forward premium and call money rate, this differential indicate some kind of arbitrage available between forex market and money market. However, as compared to 93, 94 to 2000, the arbitrage opportunity between call money market and foreign exchange market decline, and is significantly decline over the period and remain somewhere between 1 or 2% differential. This differential may exist, however, there may not be the transaction cost will be so much that forward the differential may not provide any kind of arbitrage opportunity in real term. Similarly, if you see the call money rate and forward premium and interest rate differential, here interest rate differential I mention here between call money rate and Fed fund rate, that is Fed fund is the US money market interest rate, Fed fund rate, and what is the difference between Fed fund rate and call money minus the Fed fund rate, I put in one term called interest rate differential between India and US, and here forward rate between INR and US dollar. The green line indicate the forward rate between INR and Indian rupee and US dollar, and the blue line indicate the interest rate differential, the money market interest rate differential between India and US, and these two rates should almost remain same or almost have minute level difference should be there, so as to indicate no arbitrage between Indian market and the foreign exchange, Indian market and the US market. However, if you see the arbitrage in 93, 95 up to 2000 it was quite high, after that it is reduced some extent, however, it is quite high in 2005, 6, 7 and 9, and after 9 the arbitrage decline little, that is the difference between forward rate interest rate differential is bridged. However, between 2003 to 2007, 2009 I can mention it has quite high differential, and differential exists because of the financial sector instability, where forward premium was quite high compared to the interest rate differential. So, this is because of uncertainty in the foreign exchange market, which is another variable which may lead to may lead to high forward premium. If you see the change in the spot rate and forward rate, I have taken here 1993 to 2012 the forward premium and the spot INR and USD exchange rate change. So, if you see the green line indicate the forward premium and the that blue line indicate what is called the change in the spot rate between USD and INR. The INR USD spot rate change indicates the volatility in spot rate and spot rate between India and USD, and this volatility should be absorbed by the forward premium. If you see the volatility, though volatility is declining in volatility remain some extent constant in the 95 to 2002 and forward premium also remain highly volatile during that period. After 1998 it remained constant, and after 2002 it increased significantly, and also the volatility also increased significantly. If the volatility of foreign exchange INR and USD increase, forward premium also increase, and this because of the instability in the foreign exchange market in India. If you see other change in the spot interest rate differential. So, as I mentioned earlier, the change in spot rate should be equal to the interest rate differential if there is no arbitrage opportunity between money market and forex market. If differential exists, then there will be arbitrage between two market. If I have mentioned here spot exchange rate change, spot exchange rate change is the blue line, and how it is volatile over the year. If you see some extent less volatile from 94 to 2002, after that the 2003 onward the volatility is quite increased significantly. Between the financial sector crisis time 2007, 8, 9, 10 it is highly volatile in between Indian rupee and foreign USD. However, the interest rate differential, that is a call money rate minus the Fed fund rate, that is interest rate differential between the two money markets of India and US. The money market differential, that is interest rate differential also fluctuating along with the fluctuation of the spot and foreign exchange spot market spot rate between Indian rupee and USD. Though they are not almost same, but the volatility is same between the two markets. They indicate that interest rate, the spot exchange rate volatility has transferred to the interest rate differential all money market. And whenever there is a volatility in the spot market, this reflect in the interest rate, and further it reflect in the forward premium. So, there is a transfer of volatility of exchange rate, to money market side. So, these two markets are highly volatile as the graph indicates. Similarly, if you see the call rate and Fed fund rate, though if the call rate and Fed fund rate move in the same direction, the volatility, the arbitrage opportunity may be less over the year. If you see in 1993 to 24, the rate differential is quite high. After that they are moving in tandem to each other. Call money rate and Fed fund rate, this red line indicate call money rate and the light pink line indicate that Fed fund rate. These are also moving in tandem. However, there is some year the differential is quite high, and this may reflect in spot either in exchange rate volatility between INR and USD, or in the spot rate, or in the forward rate. So, that also part of the volatility transfer between the call rate and forward Fed fund rate to the other segments of money market or to the forex market. However, the Indian call money rate and the Fed fund rate of US moving in tandem to each other. So, when you understand that the Fed fund rate, call rate, interest rate differential, spot INR and spot rate all are linked to each other, and the volatility among them, the movement among them reflect the relationship or interaction among them. Then question, let us find a correlation matrix among them. So, correlation matrix I put here, I have taken the data from 93 to 2012 monthly data, and try to find the correlation of various segments or parameters of money market along with the exchange rate market, so as to understand the interaction of these two market and how these two market variables are correlate to each other. And in this case I have taken the call rate and Fed fund rate correlation. I have found the call rate, the Indian call money market rate and Fed fund rate of US. These are the two money market interest rate of India and US. They are some extent significant correlation of 0.38, though it is low, some extent both are correlated to each other. Similarly, I have taken the call rate and interest rate differential. Here interest rate differential mean call rate minus the Fed fund rate, whether the two rates are related to each other. So, I have found some extent 0.74 interest correlation, which is highly significant. The interest rate differential pulls the call rate. So, call rate and positive correlation indicate whenever the interest rate differential is high, the call rate also high. Similarly, if you see the graph, the call rate and interest rate differential, I have drawn a graph, the call rate and interest rate differential. So, if you say interest rate differential indicate the forward premium and then call rate. So, whenever the call rate is high, they are moving in tandem and positive correlations are available among them. So, similarly, I found the correlation among these two also moving quite high 0.74. Similarly, third correlation I have taken here interest rate differential and forward premium. So, whenever interest rate differential is high, the forward premium should also high, because interest rate differential is here call money rate minus the Fed fund rate, and forward premium should bridge the interest rate differential so as to not have any kind of arbitrage between money market and forex market. I have found some extent what is called positive correlation of 0.45 between the interest rate differential and forward premium. When the interest rate differential is high, forward premium also high, this indicate positive correlation 0.45. Similarly, I have taken interest rate differential and spot exchange rate. So, when interest rate differential and spot exchange rates are if you want to find that correlation, I found it 0.25 over the year last 15 years data. So, it indicates that the positive correlation indicates that when the spot rate is high, interest rate differential is high, spot rate also high. But however, the correlation is not so high here 0.25, though it is significant, not so much. Similarly, I have found the spot exchange rate change and forward premium, the exchange rate volatility and forward premium. Why I mentioned that when exchange rate volatility high, the forward premium should also be high, but I found a negative correlation among them. What is the spot exchange rate change? Spot exchange rate change, the change is positive or negative, the forward premium they have a negative relation. So, in case of India, the spot exchange rate is the change is positive and forward premium is negative. So, this may be a spurious correlation, because theoretically it is not sound. Why it is not sound? When the volatility in spot exchange rate increase, the forward premium should also increase. However, we are not finding any positive correlation among them. This may be a spurious correlation among these two. Similarly, call rate and spot exchange rate. When call rate is high, there will be more flow of foreign exchange to India, and there will be spot exchange, rupee spot will decline. So, I have found a positive correlation among them, but it is not so significant. So, 0.13 is not so high among the correlation among these two. So, correlation matrix indicate some extents of relationship between the spot exchange rate, forward premium, interest rate differential, and also the change in the spot rate. So, this correlation matrix some extent indicate that there is relationships are significant, some extent also we have found the valid correlation among these variables. Let us after going through this, let us go to what is the interest rate parity hypothesis in case of India and US. Whether the interest rate parity try to give some kind of information about the interaction of money market and foreign exchange market. So, here I have tested the covered interest parity, uncovered interest parity and try to find the deviation of this parity. Where the deviation occurs? The deviation may be because of high transaction cost, expectation of the participant, the inefficient market, maybe because of the control on money capital movement. If the both market are interactive to each other, both there is no such kind of barrier between these two market, money and forex market, then or the movement of foreign currency, the arbitrage opportunity will be least in these two market. If the covered interest parity or the uncovered interest parity holds in India or the market are abide by these two interest rate parity, that cannot be arbitrage opportunity. If there is arbitrage opportunity is there, then it may be because of movement control and capital movement, the markets are inefficient, the transaction costs are very high, or there may be expectation on the part of the participant in the financial market. So, what actually covered interest parity reflect to us or reveals to us? The covered interest parity, as I mentioned earlier, the forward premium is a function of interest rate differential. The forward premium should decide its value as per the movement of interest rate differential between two money markets, that is money market of India and money market of US. In case of we are deciding about the forward premium between USD in India and US. Similarly, the uncovered interest parity reveals us that expected change in spot rate after suppose after one period, what should be the change in spot rate and how much spot rate should change, it depends upon how much interest rate differentials are there between money market of US and money market of India. If the covered interest parity or uncovered interest parity holds in India, then there cannot be arbitrage opportunity between money market and forex market. Let us go test this covered interest parity, uncovered interest parity in case of India and US and try to find whether the interest rate parity holds in case of India, or if it there is if it is not there, then question is what is the deviations, how much deviations are there between the interest rate parity. Let us for this reason what I have done here, I have taken into account the last 1993 to 2012 data, monthly data of what is called the your forward premium as a dependent variable, and also I have taken the interest rate differential between call money market and Fed fund rate and try to find as a correlation what is called ordinary least square. I put the ordinary least square and try to find whether the forward premium, which is a dependent variable, is a function of interest rate differential. So, here the least square ordinary least square reveals that the here if you see the dependent variable is forward premium, the dependent variable is forward premium and independent variable is the constant and the interest rate differential. So, after running the regression ordinary least squares, I run it and I found that the equation is the forward the beta coefficient or the slope coefficient of each of interest differential is minus 0.294760, which is significant, statistically significant, and constant is also statistically significant, and this equation is best fit. Durbin-Watson, if you see almost 1.80, quite high, is okay. Some extent it is supposed to be 2, but it is around moving towards 2, that is okay. The if you see adjusted R square is 0.80 quite high, and the model testing is also valid, model testing is also valid. If you see the f value, the model testing is also valid. So, this equation is valid equation, the coefficient is significant, the interest differential coefficient is significant. So, this indicates the equation is significant, model is valid, and however, the forward premium is a negative function of interest differential. It means that forward premium is declining with the rising interest differential. The interest differential increases, forward premium is declining. So, that is the negative slope indicate. However, if you whether the CIP hypothesis is valid, CIP hypothesis is valid when the interest rate, if you see I plotted the actuals and the actuals of the forward premium along with the estimated of the forward premium. I estimate from this equation, every year I can estimate the forward premium, and every year forward premium data also I have, that is actual data, and plot these two equation. The red line indicate the actual forward premium, what I have data set I have with me, and the blue line indicate as per the regression equation what is the predicted line. The predicted line is here, fitted line is here. If you see 93 to 2000, 98, 99 up to 2000, I can say 2002, the differential is quite high. That is means covered interest parity does not hold in India. At the same time also the interest rate is the differential is deviation from the parity also quite high. After 2002, the parity condition, the deviation decline, and after 2007, I can say 2007-8, the parity deviation quite high because of the financial sector instability. And this indicates that though the deviation from the parity is there, the deviation is declining over the year, means Indian market and the US market moving in tandem to reduce the arbitrage opportunity between forex market and the money market. However, the interest rate differential the covered interest parity does not hold in case of India, and there is deviation is still there, the deviation though it is declining over the year. The question I mentioned earlier to you, the deviation is because of the capital control, we do not have complete capital account convertibility, we have a transaction cost which is quite high. If you move from money market to forex market or forex market to money market, we have to pay a transaction cost. The transaction cost also indicate the deviation is there, should be there between two market to remove the arbitrage opportunity. If the adjusted arbitrage opportunity you can calculate and we address just through transaction cost, a deviation may further reduce also. Same thing I have tested uncovered interest parity. Here uncovered interest parity, if you see the dependent variable is a spot change, spot exchange rate change between Indian rupee and US dollar, and it should be a function of interest rate differential. The interest rate differential, how much spot should change, how much interest rate differentials are available. If the two are same, there cannot be arbitrage opportunity between money market and forex market. I run the regression from 93 to 2012 and I found the spot exchange rate change is a function of interest rate differential. So, the interest rate differential equation, if you see, it is not a valid regression equation, though the model is not significant, the adjusted R square is quite low and the regression equation is not a valid regression equation. So, uncovered interest parity cannot be tested in case of India. However, if you see the deviation between actual and fitted, that also highly fluctuating. A green line, the blue line is fitted line and the red line is the actual line, highly fluctuating. That model is not describing anything about the interest rate differential and the spot exchange rate trend or the uncovered interest parity. So, this model is not a valid model. It may also, you can also go for some other kind of data adjustment to find a valid model for that. Then if you say that what we have discussed so far, we have taken into account the money market and forex market interaction process. We have found that some extent the both market are interactive to each other, and some extent the deviation between the two market is declining, and forex market and money market moving in tandem, and there may be some extent integration also there, but still deviation is still there, and deviation because of the high transaction cost, control in the capital movement, and also the deviation over the year declining since because of the financial sector reform measure. However, we have confined ourselves to interest rate, but foreign exchange market also influenced because of the FI inflow. When the FIs, because after 93-94 onwards we have implemented what is called financial sector reform measure, we have reduced we have allowed the FIA, that is foreign institutional investor, to invest in our stock market, invest in our bond market, and some extent the FI inflow to foreign exchange, FI inflow to our equity market has led to the some kind of adjustment in the spot exchange rate. Whether the spot exchange rate have any kind of relationship between the BSE sensitive index return, whether the index return influence the index return influence the spot exchange rate, whether there is a relationship between the BSE sensitive index and also with that of what is called the foreign exchange market, because FI inflow lead to appreciation or depreciation of rupee, which may also reflect in forward rate agreement, forward rate premium or discount of forward rate. So, the forward rate, the FI inflow, the in BSE index return and the spot exchange rate, may be some kind of relationship will be there. Let us find the relationship, whether it is available in case of India, the relation is valid in case of India, whether you can modify the interest rate hypothesis, that is in covered interest hypothesis, uncovered interest hypothesis through the BSE return index. Let us do some kind of analysis in this area. So, I have drawn a graph here taking into account BSE return, BSE index return and Fed fund rate, whether there is a relation among this. The BSE return is in the blue line. The BSE return some extent 93 to 2012, some extent 2-3% are there over the year, and whether the forward premium is the green line, how it is fluctuating, and the Fed fund rate is the red line. So, Fed fund rate, and with we looking at the graph, we cannot decide whether there is any kind of relations among them. The graph long run tendency is that both are declining, and tendency is that both are moving in the long run with a declining trend. However, there is no such kind of pattern relationship. The pattern of change it does not reflect here. However, if you some extent go further bifurcation, whether the forward premium a return differential, here return differential I have taken, with the return differential and forward premium some extent relations is there, because FIs are coming to India, they are investing in stock market, and the movement of stock market, the return of the stock market influence the or pulls the FI to Indian market. Indian foreign if BSE or the NSE giving good return, FI will invest there, and with the FI the foreign exchange will come to India, rupee will depreciate or appreciate depends upon the flow, and appreciation or depreciation or volatility of rupee reflect in forward rate, forward premium or discount. So, whether this kind of relations are there, if you see the BS return differential between the your Fed fund rate and the BSE index is fluctuating, and same extent also forward premium also fluctuating. So, interest rate differential will highly fluctuate, forward premium also moving upwards. So, whenever there is a decline in return, forward premium is declining, So, when it increase return, forward premium is increasing. So, with the rising in return from the forex market, your BSE index, rising return in the equity market pulls forward premium, pulls your FI to India. FI will come to India looking at the high return in the forex in the BSE index, and when they bring more foreign exchange to India, the rupee will appreciate or depreciate because of the movement of FI, and the depreciation create volatility in the spot market, and the volatility high, forward rate will be, forward premium or discount will be also high. So, that is the relationship among these two markets, and these two markets are moving in tandem. The graph indicates two markets are moving in tandem. Similarly, I have drawn a INR spot change, a return differential. When return differential, that is equity market is giving more return, there will be more FI in equity market, and this FI when comes to India, there will be fluctuation in INR and spot, INR and rupee rate, INR and USD rate, and the INR and USD fluctuation may reflect in return differential. So, I have done a two graph between the INR and USD and return differential. I have found the return differential is highly remains stable over the year last 12-13 years, some extent 4 to 5%, 5%. However, the return differential is fluctuating. This indicates that the instability in the BSE market or the equity market leads to fluctuation of FI inflow. When the rupee and the fluctuations are there in FI inflow, it reflects in the spot exchange rate change, and this change leads to the forward premium volatility. So, similarly, I have done another graph, try to find the INR spot change, return differential and FI change, FI inflow. So, if you see the green line indicate FI change, FI inflow changing or the percentage change of FI inflow every year. The red line indicates return differential between BSE and the forward your Fed fund rate. These two are moving in tandem. So, more when the return differential and FI are moving in tandem, they are highly correlated, and the FI fluctuation of FI investment in Indian stock market giving a volatility in Indian spot exchange rate between USD and INR. This indicates that these three are highly correlated, and some extent they are moving in a one direction. The direction is nothing but FI inflow, return differential changing and changing in the spot rate. This is a relationship among them. So, I try to find the correlation among these three and found that FI investment and BSE return, they are highly correlated 0.835. When FI investment in BSE return is increasing, more FIs are coming to India and they are highly correlated, positive correlation 0.836, 0.835 indicate the FI inflow and BSE return are highly correlated. Similarly, I found BSE return and INR USD change. So, BSE return is declining, the fluctuation of INR and spot, the INR and USD spot, the fluctuation and BSE index, they are negatively correlated. The BSE return is declining, INR is highly fluctuate, BSE return is increasing, INR is spot is declining. They are also negative correlation 0.64 indicate that some extent relationships are there between these two variables. Similarly, I found BSE return at Fed fund rate differential and forward rate. The return differential between BSE return minus Fed fund rate and the forward rate. So, whether the forward premium or discount is because and the return differential are correlated, though I found some extent correlation among these two, but the correlation is around 0.24%, both are positively correlated, but not so significant, not so high. So, there are some degree of relationship between FI inflow, BSE return, spot exchange rate change and the return forward market, forward rate or forward premium or forward discount. All these 4 variables are having some extent of correlation. I try to find what is the interest rate parity hypothesis. Here in place of interest rate I have taken BSE rate, BSE return. So, our return differential, whether the covered return parity, nowadays parity, interest rate parity nobody is using, they are using because FIs or foreign exchange are coming to India primarily because of BSE return in available in stock market. So, return differential is equal to forward premium. So, forward premium is reflected through return differential, forward premium is reflected to the interest return differential. I found here a forward premium is a function return differential to try to find the covered interest parity. The return differential available between BSE return and the Fed fund rate should be reflected in the forward premium. Similarly, uncovered interest parity, the change in the spot rate between INR and USD should be a function of return differential. How much INR and USD should change in the spot market, how much interest rate differential are available. If these two are abide in by the market in India, then there cannot be arbitrage opportunity. However, this may not be true in case of India, since arbitrage opportunity definitely will be available. Let us test these 2 hypotheses. Similarly, I have done the OLS regression. I have found covered interest parity hypothesis, covered rate return parity, and I have taken forward premium as a dependent variable which is function of return differential. I have found it is not abide in India. So, return differential is not deciding, return differential is not deciding the covered in forward premium in India. Similarly, uncovered interest parity deviation, if you see the deviation between the forward premium interested from the covered rate parity, the green line indicate the fitted line, blue line indicate the fitted line and red line indicate the actual line. There is no such kind of relationship among these two. So, forward premium is not decided by the return differential between BSE and Fed fund rate. So, they are 2 independent variables. Similarly, I have run the uncovered rate parity. Here the dependent variable is INR spot change and independent variable is your return differential. So, the return differential deciding the INR spot change, this also does not hold in case of India and there is no relationship these 2 variable. So, and that graph also telling there is no relationship, the actual is fluctuating, actual red line is highly fluctuating, blue line is nowhere deciding the red line. So, there is no difference, there is also here no return differential not reflecting the forward premium. So, though FIs are coming to India, they are influencing the BSE return or NSE return, they are also influencing the spot rate, but nowhere the forward premium or spot rate is highly dependent upon the return of the BSE or NSE in Indian case. So, along this let me conclude that there is some kind of relationship in Indian context between money market and forex market, and money market rate, particularly the call money rate and the forward premium is highly dependent to each other. They are interdependent, and forex market there is a spot market and forward market of forex market have some kind of relationship with the call money rate. However, the FI inflow which influencing the BSE or NSE return, equity market return, not deciding the forward premium and not deciding the spot market also, spot market of INR and USD. So, though interest rate parity some extent available in India, it does not hold. However, over the year over the interest rate, the deviation from the interest rate parity is declining. However, it is not so in case of return parity, where return is the BSE or NSE equity market. So, with this let me conclude this. Some model question I have designed for you. So, it is like that, while defining the parity hypothesis, outline various theories of interest rate parity. So, you have to mention what is parity hypothesis here, and try to differentiate the covered interest parity, uncovered interest parity and real interest parity, how they are different from each other. And here you have to mention that in parity hypothesis, try to address the relationship between interest rate differential and the forward premium of discount. You try to reflect the relationship between the money market and forex market, and covered interest parity reflect the forward premium should be equal to the interest rate differential. Uncovered interest parity reflect that the forward premium should decide the fluctuation of the spot market, and real interest parity try to address the issue of inflation or the nominal and real interest rate, how they are linked to forward premium and discount. Second question is here, bring out the relationship between money and forex market. You have to find out the various instrument of money market, you have to find out the various instrument of forex market, how these two markets are related to each other, what is the movement of these parameters, two markets parameters variable, and how they reflect the relationship among them. We have discussed in detail these two cases. Similarly, third question is describe the region of deviation from interest rate parity in the Indian context. You have to discuss here where the deviation occurs between interest rate parity, because the arbitrage available between two markets, the arbitrage available, why the arbitrage are there? The arbitrage may be because of in lack of information, the arbitrage may be because of transaction cost, the arbitrage may be because of the control of capital movement. You have to address all this issue and try to find out if there is other reasons of not holding of interest rate parity hypothesis in case of India, because it may be because of expectation of participant in the foreign exchange market, it may be lack of information. So, all these things you discuss in the third question and try to find the reason why deviation interest rate parity does not hold in case of India. Thank you.